Most people dive into investing with big dreams of getting rich, but the harsh truth is, many are making costly mistakes that could ruin their chances of success. Are you one of them? From chasing hype to ignoring risk management, these errors can drain your savings before you even realize it. In this video, we'll uncover the 5 biggest investing mistakes and how to avoid them. Whether you're a beginner or have been in the market for years, understanding these pitfalls could save you thousands. Stick around to learn how to invest the right way. Today we will talk about why most people are investing all wrong. 5 mistakes you need to avoid. So before we get started, make sure to hit that like button, also subscribe to my channel. Investing is one of the most powerful ways to grow wealth, but most people are doing it wrong. Instead of building financial freedom, they end up losing money, making poor decisions, or never achieving their financial goals. Why? Because they fall into common traps that could have been easily avoided. The reality is that investing isn't just about picking stocks or following trends. It's about strategy, patience, and knowing what not to do. In this video, we're breaking down the 5 biggest investing mistakes that most people make and how you can avoid them. Mistake 1. Trying to time the market. One of the biggest mistakes investors make is trying to predict when the market will go up or down. People believe they can sell before a crash and buy back at the perfect moment. The problem? No one can accurately predict the stock market consistently. Even professional investors fail at market timing. Instead of waiting for the right time to invest, the best strategy is to stay consistent. Investing regularly over time, known as dollar-cost averaging, helps smooth out market fluctuations and reduces the risk of making emotional decisions. Mistake 2. Investing without a clear plan. Many people start investing without a strategy. They hear about a hot stock, cryptocurrency, or a once-in-a-lifetime opportunity and jump in blindly. But investing without a plan is like driving without a destination. You need a roadmap. What are your financial goals? Are you investing for retirement, wealth building, or short-term gains? Do you have a diversified portfolio? Having a clear investment strategy helps you stay focused and make rational decisions rather than impulsive ones. Mistake 3. Letting emotions control your decisions. The stock market is full of ups and downs, and one of the worst mistakes investors make is letting emotions drive their decisions. Fear and greed are the 2 biggest enemies of smart investing. When markets crash, inexperienced investors panic and sell at a loss. When markets boom, they buy at the top because of FOMO, fear of missing out. Successful investors remain calm, stick to their strategy, and understand that market downturns are temporary. The key is to think long-term, not react emotionally to short-term fluctuations. Mistake 4. Ignoring diversification. Many investors make the mistake of putting all their money into one stock, one asset class, or one type of investment. They hear about a company that's guaranteed to explode and go all in. The problem? No investment is risk-free, and anything can happen. The best investors diversify their portfolios to spread risk. This means investing in a mix of stocks, bonds, real estate, and other assets. Diversification protects you from losing everything if one investment fails. It's a fundamental principle of smart investing. Mistake 5. Neglecting to do proper research. Too many people invest based on hype, social media trends, or tips from friends without doing their own research. Every investment should be backed by thorough analysis. What is the company's financial health? What are its long-term growth prospects? Are there risks that could impact its success? Taking the time to research before investing prevents costly mistakes and ensures you're making informed decisions rather than gambling with your money. The impact of these mistakes on your financial future. The reason these mistakes are so dangerous is that they don't just cost you money in the short term. They can delay or even destroy your long-term financial goals. If you panic sell during a downturn, you lock in losses. If you chase hype, you risk buying at inflated prices. If you don't have a strategy, you're more likely to give up when things get tough. The good news: avoiding these mistakes isn't difficult. It just requires discipline, patience, and the right mindset. The power of long-term investing. The most successful investors understand that wealth isn't built overnight. Investing is a long game. The people who make the most money in the stock market are those who stay invested for decades, not days. Warren Buffett, one of the world's greatest investors, has made billions by holding on to solid investments for the long term. The longer you stay in the market, the more you benefit from compound growth, the ability of your investments to grow exponentially over time. How to avoid these common mistakes? Now that you know what not to do, let's talk about how to invest the right way. First, have a clear investment plan. Know your financial goals and risk tolerance before making any moves. Second, stay disciplined. Avoid panic selling or making impulsive decisions based on market fluctuations. Third, diversify your investments to minimize risk. And finally, always do your research. Invest in assets that have strong fundamentals and long-term potential. The role of index funds in smart investing. If you're looking for a simple, low-risk way to invest wisely, index funds are one of the best options. Index funds track the performance of the overall market, such as the S&P 500, and offer instant diversification. Instead of trying to pick individual stocks, you invest in the entire market, which historically grows over time. This is why many financial experts recommend index funds as a foundation for any investment portfolio. Why passive investing beats active trading? Many new investors fall into the trap of thinking they need to be actively trading stocks to make money. They buy and sell frequently, hoping to make quick profits. But research shows that most active traders lose money over time. Passive investing, where you invest consistently and hold for the long term, beats active trading in almost every case. The less you try to outsmart the market, the better your returns tend to be. Common myths about investing that hold people back. One of the reasons so many people invest incorrectly is because they believe in common myths about investing. Some people think you need to be rich to start investing. Others believe investing is too risky or complicated. The truth? Anyone can start investing with just a few dollars. And with the right approach, investing is one of the safest ways to build long-term wealth. The biggest risk isn't investing. It's not investing at all. If you've made any of these mistakes before, don't worry. It's never too late to fix them. The most important thing is that you start making smarter investment choices today. Build a solid strategy, stay patient, and focus on the long-term benefits of investing. The sooner you start investing the right way, the faster you'll build wealth and achieve financial freedom. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.